Hi everybody, I hope you had a wonderful Christmas. Welcome back to Enter Crypto with me, Chris Kenyon. If you are investing in cryptocurrencies or thinking about it, then today's topic is a must watch. We're exploring how crypto tax regulations in the US, the UK and the EU could shape your financial future in 2025. And this is because tax laws are changing fast, and one mistake could cost you hundreds, thousands, or even worse, or even lead to legal trouble. But don't worry, I've got you covered, and by the end of this video, you'll know exactly what to expect and how to stay ahead of the curve. So let's dive in. So before we dive into specific regions, let's talk about the big picture. Cryptocurrency taxation is no longer a fringe issue. Governments worldwide are racing to regulate digital assets as the market matures. Why? Because crypto is no longer just a niche, it's a $1 trillion industry. In 2022, the global crypto market peaked at over $3 trillion, and now with growing adoption, countries are tightening regulations to ensure that they get their share of the pie. But here's the catch. Every country has its own approach. Some treat crypto as property, others as digital assets, and these distinctions can make a massive difference in how much tax you pay. Let's start with the United States, where the IRS has been laser focused on crypto investors. So in the US, the IRS categorizes crypto as a digital asset, much like stocks or bonds, and this means that the way you use your crypto determines how it's taxed. So let me break it down. You have got non-taxable events and taxable events. Some examples of taxable events would be selling crypto for a profit, which is capital gains, converting one cryptocurrency to another, so that might be swapping Bitcoin for Ether, and also using crypto to buy goods or services. Some non-taxable events would be just buying crypto and then holding it, so not selling it. Another non-taxable event would be just receiving crypto as a gift. That's not taxable in the US, and also donating crypto to a qualified charity. And so, for example, if you bought Bitcoin for $10,000 and then sold it for $15,000, you'd be responsible for paying capital gains tax on that $5,000 profit. But what if you use Bitcoin to buy a car? That's also considered a sale, and so you'll owe tax on the profit from when you bought the Bitcoin to when you used it. And actually, I think many crypto users don't realize that they are supposed to or need to report their holdings. And as tax scrutiny increases, which it will in 2025, being proactive is crucial. And let's not forget about income tax, because if you are mining or staking crypto, or if your employer pays you in crypto, then that's treated as regular income, and it's taxed accordingly. Even staking rewards are taxable when received. So this is why understanding US tax law is so important if you live there. But let's move to the UK now, where the rules have their own quirks. Now, the UK's approach to crypto taxation is slightly different. HMRC considers crypto an asset, which means that it's subject to capital gains tax. But what counts as a taxable event in the UK? Well, selling crypto for fiat currency is just, for pounds, a government issued currency. Using crypto to purchase goods or services is another one, swapping one crypto for another, and also gifting crypto. The only exception to gifting crypto in the UK would be if this was to your spouse. And so if you were in the UK and you traded Bitcoin for Ether, even if you didn't cash out, HMRC would consider this a taxable event, and you're going to have to calculate the value of the Bitcoin when you traded it and then pay tax on any gains. And at the moment, for basic rate taxpayers, it's 10% on gains over £3,000, and for higher rate taxpayers, it can be up to 24%. But here's where it gets interesting, because the UK government has been working to make the country more crypto friendly, and they have introduced this £3,000 exemption for small investors. And are exploring more policies to compete with the US as a crypto hub. So could 2025 be the year that the UK becomes a global crypto leader? Only time will tell. Now let's turn to the European Union, where crypto regulations vary dramatically by country. In Germany, for instance, crypto held for more than a year is tax-free. So this is a huge incentive for long-term investors. And I wouldn't even say medium-term, because 12 months is not a long time. But sell within a year and you could face income tax rates up to 45%. Plus a 5.5% solidarity surcharge. In Spain, things are stricter because all crypto gains are taxed as income, with rates ranging from 19% to 28%. In Portugal, which was once a tax haven for crypto, now taxes gains at rates between 14.5% and 53%, depending on your income bracket. But the real game changer in the EU are these new MiCA, markets in crypto regulations that have just come out, and they're set to take effect in 2025. And these regulations aim to harmonize crypto laws across all the member states. And they're arguing that it focuses on anti-money laundering and financial crime prevention. And this sort of increased oversight could actually discourage crypto investments in some countries, but also promises more clarity for investors operating across borders. So if you're planning to invest in the EU, keep an eye on these developments, because these harmonized rules might simplify compliance, but they're also going to increase scrutiny on your activities. So let's talk about what you can actually do to prepare for 2025. What's the bottom line? Well, as 2025 approaches, the global crypto landscape is becoming more regulated. And this isn't necessarily a bad thing, but it is a real thing, and it's a sign that crypto is being taken seriously. But it does mean that you are going to need to stay informed and proactive. And some of the things that I do that you may find helpful is, well, here's just 3 things that I do. One is keep accurate records. I know it's a pain, but track every transaction, your buys, your sells, your trades, and your staking rewards. A lot of exchanges, if not all, will let you download, I think it's a CSV file, and it'll tell you all your buys and your sells and everything, and you'll be able to work out what tax you need to pay from that. Second thing is understand the local laws wherever you live, because tax rules vary, so know the regulations in your country. And thirdly, if any of it's too confusing, too difficult, then just consult a tax professional. Especially if you're dealing with large amounts, get expert advice, because being proactive today can save you huge amounts of money later on down the line. And with 2025 just around the corner, now is the time to start planning. That's a wrap for today's deep dive into crypto tax regulations for 2025. If you learned something new, hit the like button and subscribe to Enter Crypto. What do you think about these tax changes? Are they a step forward or a step too far? Let me know in the comments below. Thanks for watching. Stay smart, stay safe, and as always, stay invested. And I'll see you all next time.